Hey guys, Sean from Rest to Live, hitting you with a sneak peek for the week. We're coming up on episode 26, so it's been a good couple of weeks really of doing this. Missed a few due to some technology issues, and then also just having a general cold. But glad to be back on a regular schedule again. So we're going to jump right in here. So we've got another interesting week ahead of ourselves as investors and traders, and it's very important that we're aware of what that looks like, what's going to be coming down the pipe, what kind of numbers we're looking out for, what's significant for us to be aware of. And I'll tell you, I think that this is going to be, I want to say almost a really big turning point because I think more and more people are starting to get a feel that the markets have been frothy for a long period of time. It's been a very bull heavy market. I think that, for the most part, I don't know that I'm seeing anything that makes me think otherwise, but there are more of that bear conversation happening. Maybe it's time for a correction, maybe not though. So just make sure you're protecting yourself both ways. But I want to jump right in. The biggest thing and most important thing I want to talk about for this week ahead is that we have the September jobs report coming up. Jobs reports are always market movers. It's always important to understand what the data looks like, what we're expecting to see within that data set. So, at a quick spotlight for those who don't remember, we had what are I would think are pretty easily called a really terrible August jobs report, where we only saw 235,000 jobs come back, and there was an expectation of 700,000. So that caused some pretty big ripples in the market, which led to tons and tons of conversations around why aren't people going back to the market, what's causing this. Of course, on the one side, we've got the political sphere saying it's because of COVID, people are scared to go back to work. On the flip side, we've got the other side of the party saying it's because of all the programs. It's you can basically be more productive sitting at home collecting pay than you would be going to a job and doing so. I think either way, it doesn't matter. It's still an impact. So here's the deal. What we're seeing from a consensus across the board is that we should see a September payroll number of around 475,000, and that we should or are hoping to see that the unemployment rate is somewhere down to about 5.1%, which would in theory be the lowest point since March of 2020. And I think these are both really important numbers. One, from the standpoint of just getting that unemployment number down, but also seeing a big jump from the previous period to 475 would be really important. I will say this, we see a lot of stuff coming from the Federal Reserve around some of the different ongoing labor issues that they're seeing. Look, here's the deal. In my mind, regardless of what it is or what it's saying, I think what's important is people are starting to argue for a higher pay. Yes, there's lots of arguments out there for why some jobs don't pay a lot. I understand that. But at the end of the day, the more money being put into the economy and the more people that can pull themselves up should hopefully, as investors, really help us out here. Before I say another word on the earnings for the week and some comments quickly on Bitcoin and Jerome Powell, just want to call it out. I think that there's a need as investors and traders to be really successful at this job is to really get your psychology tight around what you're doing and how you're performing. That's why understanding what's coming up ahead and then understanding that supply chain of everything we talk about is affected. There is obviously a reason why we need to have an understanding of politics and what's going on around our economy based on that. But at the same time, we have to, in a sense, be almost cold to those facts. Those are just facts. We don't care what they mean necessarily as investors. We can have an entire part of our life be extremely activism focused. We can go after all the things we want to target, and that's a great thing to do. When we're talking about the way we look at our investments, our portfolios, for me, I like to really make sure that there is a brick wall separating how I feel about something and how I'm treating my investments. And I think it's important to understand that you have to look at things for what they are in real time and the impact it could have on what you hold in real time. So I just want to call that out. One other piece that was really interesting is we saw Bitcoin bump right back up to just under 50K, around $48,000 earlier in the week. And even today, as I just was checking it, it's still around that $48,000 mark. And I think a couple of key things have been really causing this to happen. Number one, we see El Salvador continuing to drive it as national currency. They're starting to do more green energy mining using volcanic energy, which is pretty cool. The other piece as well is we saw coming out of, frankly, the horse's mouth. Jerome Powell said there is no intention or no plan to ban Bitcoin in the U.S. I don't think that means there won't be regulations. In fact, frankly, I have no doubt that there will be. But just sort of one of those positive things that are good to hear when you hear what's going on over in China and how they're basically shutting it down again and again and again. But, it's just something that's really good to be aware of. And I want to call that out that there's always going to be some degree of speculation, but one of the benefits of the U.S. economy and frankly, our political system, regardless of how wild things can be at times, typically we are not an economy that looks to ban things. And I would have been really surprised if that was the case. So although Powell's saying that wasn't something I think should have moved the market, I think those are things that do create a lot of confidence in the market as well, though. So if that's the case, then hey, I'm all for it. So the other big thing happening this week that I want to end on is that there's going to be some pretty big consumer brand companies. They're going to report some earnings this week. So just a couple that I want to talk about or really focus on is PepsiCo, Constellation Brands, and Levi's. These are well-known large names. These are names to be definitely aware of. And real quick, what we're looking at is Pepsi's going to be um, doing their earnings Tuesday before the market opens. Constellation will be Wednesday before the market opens. Levi's will be Wednesday also, but after the market closes. And then on Thursday, we've got a couple more. Conagra Brands and Tilray are both going to be before the market opens. And that jobs report, we're expecting that to be, sorry about this. I'm just making sure I got my dates right in my mind here. That's expected to be Friday. So just a good call out there to make sure you're aware of that. And that's going to be coming down the pipe as well. I think a couple of the things that I was thinking about going to this week, um, and I would really urge you to do the same because I think it's really important, is just take a little bit of time, maybe tonight, maybe Monday morning, whatever the case might be, and just see if there's any risk that you're sensing in your portfolio anywhere. Are there any real susceptible names that you're holding? If you have leverage in any way on your portfolio, maybe think about how to take some of that leverage off. I'm not saying you should, or certainly that you even have to, or anything like that. I'm just more thinking out loud about how I'm doing it. And this isn't meant to be investment advice as always, because that's not what I'm doing. I'm just thinking about it in terms of how I look at it. And I try to understand where there could be risk that I'm not thinking about, or where there could be risk that could be created that's not there today. If we get another really bad jobs report and we start to see earnings of some of these major companies go down, that could be a catalyst for a downward move. Doesn't mean it will be, by the way, but it could be. And I think that's where, for me, I'm starting to get myself in a position to think about what kind of risk I'm building in, what kind of stop gaps I have. And look, I don't do a lot of videos on technical analysis, and I know there's been some asks for that, so I'm going to start to do some of that as well. But I think it's really, really important to understand that when we think about things like technical analysis, for example, you don't get one signal and instantly take action on it, right? I get a signal and I'm looking for a confirmation. I'm doing the same thing with my portfolio in general, where I'm making sure that my upside is always really strong and my downside is always very protected. So I think it's a big thing to think about what kind of risk you can carry at any given time and the degree of risk you're willing to allow in your portfolio. So as an example, if you're in very profitable positions and you think there could be a risk if these earnings come back weak or if the jobs report comes back weak, well, that's a great time to think about, do I want to have some sort of a stop loss in here and take profit at a certain level? It could be times to think about trailing stops, right? How far back are you willing to let a profit slide? And if it doesn't slide, you can always buy back in, right? So just think about those kind of things as well and how that can impact the way you're going to market on that front. On a totally different note as well, I think what we're starting to see, at least in my neck of the woods, is a bit of a slowdown on the real estate front. And there's sort of this, it's a funny thing, I suppose, when I'm about to say it, but there's sort of this like social aspect of it I like to listen to, right? Whether I'm at, my kids' sports games or whatever I'm doing, I'm out and about. The more I hear everyday regular people who are just out doing things, talking about the issues or topics that we're talking about around investing, the more I start to think, like, have we hit peak? Are we starting to come back into a bubble situation? And I'm not saying we're in a bubble. I don't necessarily think we are, but I'm at my daughter's soccer game the other day, and there's a conversation around home prices. And, if it was one of those things where, like, everyone thinks they're wildly expensive, but it's okay because my house is worth a lot, so I can sell that and buy a more expensive house and still have equal payments. And I just sort of interjected, well, a lot of it has to do with supply and demand. It has to do with what's on the market. It has to do with what the interest rates are. And for sure, you can tell sometimes people don't really understand how that works. So one thing to consider is we have really low rates right now in the US from a mortgage perspective, which allows people to take those 30-year loans and with that lower interest rate, buy a more expensive home, right? It's a seesaw effect. Low rates, prices are up. Those rates start to go up, those home prices start to go down. And we've been in a period of such low rates for so long that you do have to wonder what's going to happen if we do see an uptick at all in rates. Um, and look, the reality is this: those rates have been low for a long time. We're seeing energy prices getting very heavily pressured right now. There's talk of oil hitting $100 a barrel. I don't really know whether that's going to happen or not, or if it is, when that will be. But these are little things to always be considering as you're thinking about where you are and where your investments are. Um, I don't do a lot of the early retirement or financial independence talk on here, but I'm going to do a little bit right now, just because I think it's an interesting time to talk about it. Obviously, these are goals I have as well. One of the big considerations I often fear in the fire community, which by the way I think is amazing, but one of my big fears is sometimes the economics of the world we live in can become very disconnected and very complex, and you have to make sure you're really prepared for how those things impact with each other. So much the same way that I think about how I back test my strategy from a TA perspective, or when I think about making significant moves or trades or investments, I'm doing a lot of testing over different market scenarios or risk factors. Just some of the just easy things like what would have happened to your portfolio in '01 after the tech crash, or what would happen in '08 after the real estate crash, right? Like what happened after COVID to your portfolio. Just think about, what those could have done. And then once in a while, plan that back against your portfolio as it stands today. If you're sitting on a bunch of rental properties, how long could you go without being able to put butts into those rooms, right? How low would you have to go in your rent to still make it worthwhile and still carry your life that you're supporting? And these are just like much the same reason I tell you to think about your portfolio, because there's earnings coming out or because there's some sort of a jobs report or something similar. This is the same motion we have to take when we think about long-term planning for retirement as well. Whether that retirement is at 30, 40, 50, 60, or 70, it doesn't change the fact that you still have to be cognizant of what that long-term risk might look like. So I just want to really throw it out there. I feel like I say this all the time. It's probably the most boring thing to hear, but you have got to be planning for the downside. So with that, I want you to plan for a great week. Good luck out there. Let's get it done. Let's look out for that jobs report. Thanks, everybody.